January 29th, 2026. One date that could reshape the outlook for one of the world's most watched stocks. Apple, the trillion-dollar giant built on iPhones and services, is about to release its fiscal Q1 2026 earnings. But this report is different. Is it a beat, a miss, or something the market already priced in? Today we break down what's expected, where the risks hide, and what this could mean for the stock next. If you're trading earnings or investing long-term, this one matters. Apple is expected to report Q1 2026 earnings on Thursday, January 29, 2026, with results slated after the market close, and management on air with investors shortly after. This quarter covers the holiday season, the most important sales period of the year, typically driving Apple's largest revenue chunk. Investors will watch revenue, EPS, and guidance, but also the tone on iPhone demand, services growth, and AI strategy. Here's what the consensus looks like. Analysts expect roughly $138.3 billion in revenue and about $2.65 to $2.67 in EPS. These estimates imply around 10 to 11% year-over-year growth, driven by strong iPhone sales and services expansion. Revenue estimates range from roughly $136.6 to $142.7 billion, meaning the beat or miss sensitivity is real. In plain terms, if Apple hits these numbers or beats them, markets could reward the stock. If it misses, the drop could be immediate. And here's the catch: guidance and commentary may matter even more than the raw numbers. Let's break down the core drivers. First, iPhone sales. The iPhone remains Apple's engine. Analysts forecast robust iPhone 17 demand, especially in Greater China and North America. Selling more iPhones not just at volume, but at higher average prices, is what Wall Street wants to see. Second, services. Apple's services segment, App Store, iCloud, subscriptions, is high margin and recurring. Services growth can offset slowing hardware cycles. Third, AI and innovation. Unlike other tech peers, Apple hasn't broadcast huge AI capital spending, but analysts note its partnership with Google's Gemini for Siri enhancement. Markets will parse every mention of monetizable AI developments. If Apple beats expectations, what happens? Bullish catalysts include strong iPhone upgrades globally, services beating growth forecasts, positive comments on supply chains and AI, and even record quarterly revenue. Some analysts, including Morgan Stanley and Evercore, see reasons to be optimistic, citing product strength and higher revenue forecasts near the top end of ranges. Evercore even raised price targets into the low 300s, anticipating Apple's resilience. In this scenario, earnings beat plus positive guidance, AAPL could reclaim positive momentum after recent short-term weakness. But nothing is guaranteed. Risks include rising memory and component costs squeezing margins, tariffs and supply chain headwinds, China iPhone sales slowing in key periods, and services growth falling short of expectations. Margins, in particular, will be on center stage. Investors hate shrinking margins in a big quarter. A modest miss here could have outsized consequences. Earnings calls today aren't just about the numbers. They're about direction. Management commentary on the product pipeline, like a future iPhone foldable, AI integration timeline, services strategy, and supply constraints could move the stock even if results are in line. In other words, storytelling matters almost as much as performance. So on January 29th, Apple isn't just reporting another quarter. It's answering a bigger question. Can the world's most valuable company continue growing in a world where tech leadership is being rewritten? Beat, miss, or muddle, the reaction won't be slow. Tell us in the comments, do you think Apple will beat expectations, or is the market too optimistic?